Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct with Dukascopy TV, where we speak to financial market insiders on some of the issues impacting Australian markets. On today's agenda, it is oil, as OPEC made the controversial decision on Friday not to cut production despite those falling benchmark prices. I spoke to Lynch at OptionsXpress for more. Lynch, thank you so much for joining us again. A pleasure to catch up with you once more.
Great to see you again, Natalie.
Okay, so today we're talking oil, and on Friday OPEC made quite the controversial call really not to hold back on their oil production despite really dips in prices over the last year or so. Was this a risky call in your view?
No, look, it's classic OPEC policy to, and they've had a lot of experience in it. You've got to remember OPEC's been running the game for many years now. So obviously they're seeing the conventional low-cost oil coming out of their production spaces, and obviously they're looking to put pressure on the North American and Canadian supply. So really driven by Saudi Arabia as the main player there. They're looking for market share, and they're looking to really squeeze that North American market for the high cost oil that's coming out of there. So I would expect there'd be no real change in that stance maybe for another 6 to 9 months. I think they're really looking to put the squeeze on their competitors, really get that market share, and really signal to the market that they want to be number one.
How are investors likely to respond to this though? I mean, we've already seen a mild shift lower, but could we see that sort of bear run shift even lower still? Look,
there's always that risk, and I guess there's a number of factors in that market at the moment. The whole supply dynamic has been the story for many months now. So whilst that was in play as prices were rising, sentiment shifted. So the good thing with crude oil is that it can run contrary to some of its fundamentals. So even though there's been a big drawdown on supplies in recent times, the interesting price action that's holding is it really is a bit of a floor coming in. And if you look at the seasonal sort of plays, looking at the roadmap, I'm looking sort of at 2009 compared to 2015, and this could be the first leg up, followed by that pullback, and maybe into about the middle of this month before we go again. So there certainly has some risk to the downside, and I think a few more dollars would be the case, but certainly I don't think we're going to see those $45 lows in play again.
In terms of downside risk, risk in general really, again we've got that Chinese demand. The tiger economy imported a quarter less crude oil in May versus the April figure. That is quite a significant jump given that China is the largest importer in the world. Is this part of a trend, or is this just a one-off figure?
Look, the next read will be really critical. So I guess there's two camps which suggest that because of the maintenance with a lot of the refineries, there's normally a drop off around this time for scheduled maintenance, often about 4 to 6%, obviously nowhere near that 25% number. Looking at the figures though, they have actually been drawing down a lot on their supply, their stored oil, so that's been something that they've taken a big chunk out of. So I'll be keen to see the next read. It does look a little bit like an anomaly, but then again, if next month's come out and we're seeing sort of continual bearish figures, that will be something the market's going to have to deal with.
Naturally, our attention is now starting to shift into the second half of the year. How does all of this sort of shape your pricing forecast moving forwards, really? Look,
there's still for me, we are looking at commodities as a potential play for higher pricing across all the commodities complexes. If you look at index markets, many of them are fully priced. If you're looking at asset allocation, commodities still look to be undervalued in compared to historical norms and trends. But look, I still see June as being critical in terms of where we'll be further into the year. I know also looking at the inflation models that are starting to come out, we are starting to see a little creep in some areas, and look, that's been one of those always those things that everyone's spoken about with quantitative easing. When will inflation arrive? Now, if that starts to arrive, that's always a good story for commodities as a whole. Inflation drives them very fast. And finally, the US dollar, because we can forget. It's interesting that the crude market in particular can forget all about its supply and demand fundamentals and follow the nose of the US dollar. And obviously we've seen a big reduction in the value of the US dollar recently based upon interest rate policy that's there. Will we get those rate rises? Won't we? I'm somewhat of the camp that I don't think we'll actually see them this year. I think we could well see them into next year, but that's obviously a bit speculative at this stage. I know they want to raise them, but whether or not they get the data to do that, and if the US dollar can't get that primer to drive higher, we saw last night crude was down, but it would have been down significantly significantly more if the US dollar hadn't folded as well last night. So I think that impact of dollar and commodity pricing needs to be weighed as heavily as you're looking at the supply and demand fundamentals as well.
Big call today. We look forward to catching up with you on those later in the year. Aaron, thank you so much for your comments today.
Absolutely. Thanks, Natalie.
Coming up this week, I'll be chatting to Nikki Hutley at UBIS, and we'll also be checking in with Julius Garofali at Shaw Stockbroking. For now, though, it's goodbye from me.